The People's Bank of China cut the value of the yuan by another 1.6% this morning, making it 3.5% against the US dollar in 2 days. Global markets have been sent into a flat spin because it was so unexpected and because it indicates desperation on the part of the Chinese government. You see, Chinese firms have about $1 trillion in foreign debt, and a devaluation is really bad for them. So it's seen as a last resort economic policy. The Chinese economy must be worse than everyone thought, and as a result the Aussie dollar has dropped as well, although not as much as the yuan. But if you take a slightly longer view than 2 days, such as this year so far, you can see that the Australian dollar is down 12% because of the weakening Chinese economy, whereas the yuan wasn't down at all before yesterday. And that's about how far overvalued the Chinese currency had become. And there was some economic data out today confirming the Chinese slowdown. Industrial production, retail sales and fixed asset investment all increased less than the previous month. So commodities took a big hit last night, especially oil and base metals. And all global share markets also fell heavily because China is such an influential economy now, and all other currencies will tend to rise against the yuan, making their industries less competitive against China's. In fact, the market to do best today has been China's, since it'll benefit from the 2 devaluations. Our market fell 1.6% today, making it a full 10% correction since the recent peak in late April. The iron ore miners got hammered, and so did the banks, because of another big capital raising today, this time from Commonwealth, which you'll hear a bit more about later. And car sales put out a slightly worse result than expected, and it was driven away no more to pay. And finally, today's data release in Australia was wages growth down to a record low of 2.3%. In real terms, after inflation, Australian workers are going backwards.